All right, here's one of the concerns entering 2024 is that huge rally we had kind of in the last 10 weeks or so just pulled forward a lot of performance that maybe we would have looked forward to in 2024. So maybe that's taken away a little bit of some of the excitement for 2024. But let's check in with somebody who does this for a living. Looking to chat with Phil Colmar. He covers all this stuff here. Philip, you're managing partner, global strategist at MRB Partners. What did you make of that rally we had really towards the end of the year? I think it caught a lot of people, both in equity markets and bond markets, kind of off guard.
Yeah, well, it did, and it was breathtaking, really. But it was all on the Fed's pivot towards an easing policy, right? So we had seen throughout much of the year there was still this lingering anxieties that slowly got priced out in terms of recession fears, and that sort of solidified the pivot from the Fed, solidified the soft landing view, which I think is probably a mistake. It's going towards a no landing, but nonetheless, it solidified that, caused this rally. That being said, as you said, coming into the end of the year, there's a lot of chasing going on, and we ended up with that so-called Goldilocks scenario, fully priced or well discounted, let's call it, within both the bond market and the equity market. So.
Now, what about tech stocks? I mean, it hadn't had the best start to 2024. Apple was struggling a little bit. Then Nvidia yesterday, they helped with the rally yesterday. So what are your thoughts as far as tech stocks into 2024? I mean, how much of a part will AI play into that as well?
Well, I think the AI theme has got legs over a long haul, but I think there was a lot of euphoria associated with that, and often, that euphoria gets priced in rapidly in a short period of time, and then it takes a long time to digest for those earnings to be sustained and the penetration to the broader market. So I think the unfortunate part for tech is well, you can decompose that between the Magnificent Seven, so to speak, or the leaders and the rest. But in general, as the tech index, the unfortunate part is we have high earnings, but we have, if you look on a 5-year basis of forward earnings expectations, they're very elevated. So it's got a big earnings bar to over hurdle here, and at the same time, capex spending towards tech is weakening. So I think this is a real challenge for tech. Is there's a lot of optimism in the price and the valuation. There's a lot of optimism in earnings expectations, and that's a bigger hurdle to overcome. Whereas I think some of the laggards in even the cyclical and some select defensives have lower earnings hurdles to overcome. They offer better valuation support. So while we've seen that big rally coming into year end, I would say heading here, you still want to be positioned in sort of that laggard catch-up theme, and that kind of spreads itself into some financials, maybe aerospace and defense is some of our likes. We recently pivoted back towards energy, after being beaten up a little bit last year on a relative basis. And then on the defensive side, it's more the healthcare. So looking for that transition, laggard catch-up theme.
So we've heard financials. We actually had Scott Kroner, the strategist from Citi, on this morning. That was one of the sectors he called out here. Yep. What's the risk here? And I'm not sure how material it is for a lot of these commercial real estate loans for these banks. I'm hearing that's not so much as a risk for some of the bigger banks. Maybe it is for maybe some of the regional banks. How do you think about that for these banks?
Yeah, so I think you really should decompose them. First of all, the aggregated of the commercial real estate is nothing I know there was some scares last year, but it's nothing in comparison to the subprime crisis and all that. So let's put it on that scale. It's very small in comparison, but it's heavily concentrated within regional banks. Okay. So when you look at the loan portfolios of the big banks, they're not very exposed to it. They got great capitalization ratios, all those kind of things. So if our preference towards banks, even before that Silicon Valley mishap, because of this reason, was to favor the mega caps. Yeah.
So the JP Morgan's, the Bank of America.
Exactly. Okay. Yeah. So the well-diversified banks, they don't have a risk. The loan portfolios will suffer, and there will be some regional elements to that where you'll see more blow-ups along the way. So I would discriminate to the extent that you can. Now they dominate the index, so if you had taken the index, you're probably okay. But if you can discriminate, definitely go towards your mega caps. Yeah.
Now, in your notes, you talk about the recent dramatic easing in monetary conditions. So what exactly does that mean? Is that soft landing, no landing? And what the heck does that mean? I mean, I sound like Matt Miller in the promo.
Yeah, and I think this is the key. I mean, a lot of the market had made a miscalculated bet last year, and we leaned heavily against that there was a recessionary scenario. And now they've gotten kind of solidified around the soft landing. Now, soft landing means that you end up with still positive growth, but below trend growth, and allow for disinflation, therefore allowing for the Fed to cut rates. And I think that's a mistake, because back in October, when bond yields were higher, Fed policy was at expectations towards the top, we had a soft landing in place at that point. And everything since October, this easing, we've got interest rate expectations easing, we've had bond yields drop, we've had corporate bond yields spreads come in, we've had mortgage spreads comes in. That's a dramatic easing in monetary conditions, and that actually takes us from a soft landing to a no landing. And when I mean no landing, I mean we're not going below trend growth this year, which really has some intermediate term ramifications for the inflation outlook. We're going to be in some soft window here. well, let's call it transitory disinflation, so to speak, where the Fed can take an advantage of it in the near term as we get some soft prints. But a lot of that's pretty advantageous and kind of lucky. But if we're not going below trend, that super core basket, that services X shelter, is going to have a hard time really coming down in terms of inflation. Of course, that's a huge weight on the Fed's PC basket.
So for your investment outlook, what are you guys expecting this Fed to do this year?
So right now priced into the market's something like 6 rate cuts, so 150 basis points throughout the course of this year. I mean, I think the Fed wants to take advantage. It's been pretty clear that it wants to take advantage of this window of disinflation to try to rate cut. We expect 50, maybe 75. Nowhere a validation towards. First of all, we don't think it should cut
for the year.
For the year,
okay.
Yeah. So it doesn't need to cut. Yeah. We think it will anyway, but it won't validate what's in the bond market.
Okay. Now you talked about some of the things you liked. You mentioned energy, defense. What are you avoiding?
Well, honestly, we're avoiding a lot of the growth names related stuff. So the tech is a place where we'd be avoiding the other defensive sectors, because we're still constructive on pro growth. We just expect bond yields to come up. So we're selective on our defensives. We would be away from those bond proxies, because I think the downward adjustment in bond yields has probably had it here, where it'll soon stabilize and we'll see uplift in bond yields as the year goes on. So some of those bond proxies, the defensives, we'd avoid. We'd favor the less exposed area like healthcare. In the cyclicals, it's those traditional growth stocks. And actually, if you look underneath the surface, if you take away, as you said, those magnificent sevens, and you start to look at small cap growth versus small cap value, value has been killing it, really, the growth stocks. It's only because of those 7 that help lift it up. So there's already a transition going underway here. And so that gets into your tech-related names, whether that be in the consumer discretionary index as well, and as well as tech.
Do you have any view on the topic of the day and tomorrow, which is an ETF for Bitcoin? Do you have any view there? Are you just waiting? I mean, do you guys even traffic in any of that kind of stuff?
We get questions periodically. I mean, look, I think Bitcoin and cryptos is a theme here to stay. Or it'll come back. But often what happens, and you saw this with the original, I've spent 20 some years doing mania profiling, booms and busts and those kind of things. And often what happens is the theme comes in a whoosh, sort of like the original .com. There's a whole bunch of names and companies and stuff that were crap in that you didn't want to own, but it was a thematic, it was a new technology revolution. Then it crashed, it had to go through a digestion, a restructuring phase, and then it comes out with something more legitimate. It morphs itself. So Bitcoin might be one of the players. Most of those other cryptos will be gone.
Yep.
But we'll formulate it over the next few years as regulations come in and structure comes to that market, and then there will be some element of a legitimate theme coming back out of it. I just think we're in that window now where.
But if BlackRock calls you up Tuesday and we got an ETF, you want to buy some of our Bitcoin ETF, what do you guys say?
No, yeah. I mean, not that I follow it that closely, but no, we do track it. We do some analysis on it.
Well, how about AI? Because a lot of people are saying AI kind of feels like the internet maybe. Back in 1995, this is Dan Ives from Wedbush will say this is the 1995 moment for AI, that this is really going to be established as something across, it's just going to be that big. Do you subscribe to that?
Yeah, I think AI is going to have tremendous ramifications through a lot of different businesses. I think it really will penetrate, and it'll be a long-term thematic. But unfortunately, as you remember in the 1990s, the original .com, there was a lot of euphoria around it. There were a lot of, even the winners, Cisco and some of the other technology-related names that were the top of the market back then took a long digestion period while they reformulated and came back in the 2000s. So it doesn't always make a good investment. I do think that structural theme is here. I'm interested in how that penetrates other businesses rather than just the sellers of AI. How are people going to maximize profit, widen margins, those kind of things by implementing it? And I think it may have a shorter rollout than the original tech wave, but it's still going to be years. This isn't months. So
yeah, because it's interesting. I mean, Bloomberg News has done scraping of conference calls at every one of the S&P 500 companies last quarter, the quarter before that, called out AI.
Oh yeah, because it's a boost to the stock. Of course.
Well, back in the day, when it was the end of that .com bust, I took a radio company public, plain old radio station company called Entercom, and we had orders coming into our desk for the IPO from people we didn't even talk to, and we'd call them up and say, "What are you doing?" They said, "Well, we're just buying this .com thing and Entercom." And we're like, "No, it's not a .com. It's not an internet company. It's a radio company, you numbnut."
Exactly. So, and it feels like that right now.
Yeah, it feels like that. So, I mean. On the tech side, do you like if you want to play AI, do you just kind of stick to some of the big names today? A lot of people are saying just buy a Microsoft or something like that, as opposed to trying to find the niche players.
Yeah, I think probably at this phase, I mean, so there will be some real winners, I'm sure, in some of the niche players if you really sort through the mess. But I think you play the core themes. Also, right now we're dealing with an up cycle this year in trade and the semiconductor cycle. So some of the semi theme is better played outside of U.S. markets into places like Korea, emerging Asia, Taiwan,
you guys
things like that. So we do, yeah.
How much of your portfolio is outside the U.S.?
Yeah, so we do research, and we do global integrated financial markets. So we do all markets, and so we do have an overweight in emerging Asia, ex-China, and we have an overweight in Euro area as well.
Yeah, we used to when we talked about Asia, we'd be Japan and non-Japan Asia, and we don't do that anymore. But people are talking about Japan coming back. I don't know. Even Warren Buffett's talking about it. So
yeah, we have a small position in Japan.
Yep.
Well. Yeah,
all right. All right. Phillip Colmar, thanks so much for joining us. Phillip Colmar, he's a managing partner and global strategist at MRB Partners, talking all things markets across the board here.